Welcome to CryptoCore, your cryptocurrency navigator. We are diving into our daily market analysis, reflecting the data as of UTC 12:01 a.m., Saturday, November 15th, 2025.
Good morning. I think if we had to put a headline on today, it would be something like, Deep Correction Entered, Driven by Record Institutional Outflows.
It certainly feels that way. The pressure is immense.
It is. We're seeing tightening macroeconomic conditions colliding with just an unprecedented scale of institutional ETF net outflows. It's a perfect storm.
And that storm has pushed Bitcoin right down to a critical threshold.
Exactly. It's testing the $94,000 production cost for miners, which is a huge psychological level. Meanwhile, Ethereum's had an even steeper drop, and it seems to be heavily fueled by long-term holders finally taking profits.
All of which has cemented market sentiment firmly in, well, extreme fear.
Firmly. There's no other word for it.
Before we dig into the details, if you're watching, hitting that like button really supports us in gathering all this data and analysis for you every single day.
It really does.
So, here's the game plan for today's deep dive. We'll start with the overall crypto market indices to get the big picture.
Then we'll zoom in on Bitcoin and Ethereum, really dissecting their individual market action.
After that, we'll break down the most crucial international news and how it's impacting these prices. Then we'll shift to technical analysis for both assets.
And from there, we'll highlight some key trading watch points and deliver our short, medium, and long-term market outlook.
Just a quick reminder for everyone, this is a daily analysis based on the absolute latest data. If the pace feels a bit too fast or too slow, you can always adjust the speed settings right there in your video player.
All right, let's get into it.
Okay, kicking off with the overall market indices.
And just a quick note, our analysis is based on aggregated data compiled and analyzed by CryptoCore from various media reports and news outlets. So let's start with that top-line number.
Right. Looking at the snapshot from today, November 15th, the total cryptocurrency market capitalization is sitting at $3.201 trillion.
And that is a significant contraction. It's down 3.02% from just yesterday.
We're talking about a loss of around $100 billion in value overnight. When we see a widespread decline like that, what's the first thing you look for to, understand the conviction behind the selling?
It's all about the volume. The primary indicator that confirms the severity of this is the explosion in trading volume.
Okay.
While the market cap went down by about 3%, the 24-hour total trading volume jumped, and I mean jumped, by 17.66%, reaching $235 billion.
Wow. So that's not just prices drifting down on low liquidity.
Not at all. A spike in volume during a big price drop is a textbook definition of high-conviction selling. You could even call it panic-driven distribution. This was active, forced selling on a massive scale.
The short-term pain is obvious, but when you zoom out to the medium term, the shock is, frankly, even more pronounced. Let's compare today's $3.21 trillion market cap with where we were just 1 month ago on October 15th.
Right, back then, the total cap stood at $3.94 trillion.
So the difference is just staggering.
It is. Over just 30 days, the market has shed $730 billion.
Let that sink in. Nearly $750 billion wiped away.
That scale of capital evaporation, it signals a fundamental shift in market structure. It highlights just how severe this recent bearish pressure has been. It's a psychological blow that forces even the strongest hands to rethink their positions.
And that psychological shock is just perfectly captured by the sentiment indicators, isn't it?
Absolutely. The fear and greed index dropped even further. It moved from 25 yesterday, which was already in fear, down to 22 today.
And that is getting dangerously close to the extreme fear zone.
Very close. That zone typically marks these deep capitulation phases. And if you compare this 22 reading to the 40 we saw a month ago, that's an 18-point collapse.
It's a massive erosion of investor confidence.
It's a move from simple caution to something bordering on outright terror, all within a few weeks. Now, for technical traders, these low readings are often seen as contrarian buy signals, but
only if the structural pressures actually subside.
Exactly. You can't just buy a low number when the fundamentals are this stressed.
Now, here's something really counterintuitive that I think needs careful analysis. Bitcoin dominance. Usually, when the market crashes and Bitcoin leads the sell-off, altcoins suffer way more, right? So BTC dominance should rise as capital flees to safety.
That's the standard playbook.
But today, BTC dominance actually dropped. It went from 60.19% yesterday to 59.55%. And the alt-season index even ticked up slightly from 29 to 31. What is going on there?
This is a critical paradox, and I think it points directly back to the primary driver we mentioned at the top, institutional flow.
It's all about the ETFs.
It has to be. Think about it. Bitcoin's decline over the last 24 hours was a massive 4.79%. The overall altcoin market, let's say represented by the CMC 20 index, dropped 4.23%.
So alts actually outperformed Bitcoin, relatively speaking.
Exactly, and that implies two things. First, the institutional selling specifically through those ETFs was almost entirely concentrated in Bitcoin, forcing a deeper proportional drop there.
And second,
the altcoin market, especially those top-tier alts, might be showing a bit more resilience simply because there was less forced institutional liquidation pressure. It temporarily distorts that dominance metric we usually rely on during market stress.
that institutional capitulation point just seems to be the linchpin for this whole move. Can you put that $1.13 trillion outflow into context for us?
I mean, this is the core engine of the entire downturn. The institutional capitulation is real, and it's record-breaking. As of the November 13th close, total spot ETF net outflows hit that eye-watering $1.13 trillion.
And that's combined BTC and ETH.
Yes. It includes $868.66 billion from Bitcoin ETFs alone and $259.6 billion from Ethereum ETFs. And for ETH, that was its third straight day of institutional withdrawals.
This isn't just minor profit-taking.
Not even close. This magnitude of institutional exit is a structural dump. It provided the overwhelming bearish force needed to smash prices below key support levels that had held up for weeks.
And I imagine this forced exit left some serious tracks in the futures market. Mass liquidations must have happened.
Absolutely. We can see that clearly in the open interest, or OI. OI for both perpetual and standard futures decreased compared to yesterday.
So that confirms the longs got wiped out.
It confirms that the price collapse caused large-scale liquidations of leveraged long positions, which, effectively cleaned out some of the excess risk in the system.
Okay, but here's something interesting. Despite those liquidations, the 24-hour funding rate actually went up slightly.
It did, from 0.005% to 0.007%. It's a tiny move, but it's significant. It indicates that after the dust settled, short positions are now starting to pay a very small premium to maintain their exposure.
So shorts might be getting a little too aggressive.
It's a minor technical signal that suggests that, yes, it offers a marginal hint of a potential, albeit small, short-term relief bounce. But I have to stress, overall, the market remains deeply bearish.
And moving beyond the funds and futures, we also saw a notable shift in how corporate treasuries are treating their Bitcoin.
That's a key structural change we have to watch. The Bitcoin Treasury ratio, which measures the percentage of corporate assets held in BTC, dropped from 5.04% to 4.82%.
That's a 0.22% decline. Why is that so significant?
It's significant because companies usually hold their BTC reserves with a very long-term, rigid HODL perspective. A decrease here implies that some of these corporate entities were either forced to liquidate parts of their holdings or, at the very least, restructured them amidst the panic.
Which is a really rare event.
Extremely rare, and it adds another structural layer to the bearish pressure. It suggests the pain is filtering up from institutional funds right into corporate treasuries.
And finally, a massive spike in volatility, which just confirms that everyone expects more of this instability.
You got it. Volume X implied volatility confirmed that. BTC implied vol jumped to 51.31, while ETH vol jumped to 80.37.
And Ethereum's volatility is way higher than Bitcoin's.
Much higher. And that underscores that the altcoin market, especially post-ETF outflows, is perceived as much higher risk and far less predictable than Bitcoin right now. So to sum it up, the market is just buckling under this huge institutional selling pressure.
Okay, let's zoom in and focus specifically on Bitcoin now. The price is currently at $94,679. That's a plunge of 4.79% in just 24 hours. The speed of this fall has just been brutal.
It really has. The short-term pain has been acute. If you look back just a few days ago, on November 11th, Bitcoin was trading comfortably above $105,000.
And in just 4 days, we've seen a swift $10,000 drop.
Culminating in this test of the huge psychological and technical $94,000 mark. This kind of rapid decline is indicative of a cascade, where that ETF selling triggers mass long liquidations, which then feeds on itself.
The losses across the different time frames really paint a grim picture of this correction. Our 7-day return is now negative 8.36%.
And the 30-day return is at negative 14.56%.
Compared to the price a month ago, $113,000, we've lost over $18,000 per coin. The 90-day return is almost 20% down.
And the annual return is barely clinging to positive territory at 1.37%. That suggests nearly all the gains from the start of this year have been wiped out.
The supply and demand picture just reinforces this whole bearish narrative.
It does. Bitcoin's 24-hour trading volume hit $114.2 billion. That's an increase of over 13% from the day before.
And that increased volume confirms heavy distribution, right? Sellers are just aggressively offloading.
That's exactly it. The market isn't just retracting, it is actively being sold off.
And as we've established, that primary catalyst was the institutional floodgate opening. We have to reiterate the impact of that record $868 billion ETF outflow on November 13th.
That volume was the hammer blow. It's what forced the price decisively below the $97,000 psychological support. And crucially, on-chain data confirms where this liquidity stress came from.
What does CryptoQuant's analysis show?
It points specifically to aggressive selling during U.S. trading hours, which of course aligns perfectly with when ETF outflows are typically realized and settled.
And it's not just the institutions.
No, there's also been widespread profit-taking by long-term holders, or LTHs. These are investors who've held their coins for years. On top of that, the deeply negative Coinbase Premium Index highlights that the selling pressure is disproportionately high among U.S.-based investors, which again points to institutions.
And we even saw some movement from major institutional wallets like Galaxy Digital.
We did. As the price collapsed below 95,000, wallets associated with Galaxy Digital saw a sharp outflow of about 200 Bitcoin.
Which is a signal in itself.
It is. It doesn't necessarily mean a permanent strategic shift, but it confirms that even sophisticated institutional players were liquidating or de-risking as that $95,000 support just fractured.
Now, countering this narrative of institutional fear, we have Michael Saylor at Strategy, who publicly denied any massive sales. He claims they're actually accelerating purchases.
Right. He framed those large on-chain transfers we saw as just part of a $5.7 billion custody reshuffle.
But the market reaction suggests deep skepticism.
To put it mildly, we're now seeing a very rare phenomenon where Strategy stock, MSTR, is trading at a discount to the actual value of its Bitcoin holdings. The MNAV is at 0.96.
What does that mean for investors?
It means they're factoring in concerns about potential corporate dilution and the excessive leverage risk tied to Strategy. It's a crucial shift. Investors now clearly prefer direct BTC exposure rather than using a leveraged corporate proxy. That rarely happens when confidence is high.
So, given the current price, the focus is intensely on this $94,000 threshold. JPMorgan called this the pain threshold. Why is this level so critical?
JPMorgan identified $94,000 as the adjusted production cost floor for Bitcoin miners.
So this is where it starts to become unprofitable for them to operate.
For a significant portion of the network, yes. Historically, miners fight tooth and nail to defend this line. Failing to hold it means they're operating at a loss, or at least at significantly reduced profitability. It's a pivotal point.
And if 94,000 fails to hold?
If that happens, technical analysts largely agree it could trigger a cascade. It would force less efficient miners to shut down, and that could drive the price rapidly down toward the next major technical support, which is likely somewhere around $88,000.
If you find this analysis helpful in navigating these choppy waters, please consider hitting that thanks button below to buy us a coffee. Your support is absolutely invaluable for our data collection efforts.
It really is.
Yeah.
Okay, let's move on to Ethereum.
Right. Ethereum is currently trading near $3,117. It's down about 3.23% in the last 24 hours, with a market cap of $376 billion.
And while Bitcoin's drop was significant, Ethereum's recent correction has been, even more punishing over a slightly longer time frame.
That comparative drop is really the key here. When we look at the monthly performance, the pain for ETH is just so much more acute.
It is. 30 days ago, the price was at $4,125.
That means ETH has plunged a whopping 21.85% in a single month. That's significantly steeper than Bitcoin's 14.5% drop during the same period.
And that stark difference really illustrates Ethereum's higher beta risk. It tends to perform better in a bull market, but it gets disproportionately punished during downturns like this.
The other timeframes aren't pretty either.
No, the 7-day drop is over 9%, and the 90-day return is a negative 29%. And disturbingly, the annual return for Ethereum is now negative 6.4%.
So if you bought ETH at the start of 2025, you are currently underwater.
You are. And the primary source of this intense selling pressure seems to be internal. It's coming from some of the network's oldest, most resilient investors.
We're talking about the long-term holders, the LTHs, capitulating.
That's exactly right. On-chain analysis shows that long-term addresses, we're talking wallets that have held ETH for 3 to 10 years, have intensified their selling dramatically.
How much are we talking about?
They've moved or sold an average of 45,000 ETH per day over the last 3 months.
Wow.
This level of activity from that specific cohort is the highest we've seen since February of 2021. It suggests that some of the most experienced investors are either taking profits before a deeper correction or reallocating assets. Either way, they're directly fueling this bearish trend.
And when LTHs are selling so aggressively, that naturally translates to weakness in the futures market.
It does. Crypto quant data confirms that the net taker volume for Ethereum remains negative. That means sellers are dominating the futures market, driving the price down with aggressive market orders.
And the institutional picture is no better.
No, it just compounds the problem. As we mentioned, ETFs recorded nearly $260 billion in net outflows on November 13th, marking that third straight day of institutional withdrawal.
Okay, but this leads us to that classic crypto contradiction. We have extreme selling from long-term holders and institutions fleeing, but it's being met by smart money accumulation.
This is the fascinating dynamic playing out right now in that $3,100 to $3,200 range. Despite the crash, on-chain data shows that smart money whales are actually increasing their accumulation.
So they're buying this dip.
They are systematically pulling large amounts of ETH off centralized exchanges, like Binance. This large-scale withdrawal reduces the available supply on exchanges, and it signals that these big players view this current price range as a crucial long-term accumulation zone. They're confident that the fundamental long-term value outweighs this current macro panic.
Technically speaking, though, the current price puts Ethereum in a real make-or-break zone. What's the significance of the level it's testing right now?
It is testing the weekly 50 exponential moving average, or EMA. This is a critical long-term trend line that has acted as both strong support and strong resistance for over a year.
So losing this would be...
Losing this support risks a rapid descent. Technical models indicate that failure to hold this $3,100 to $3,200 range could trigger a substantial drop toward the $2,800 level and potentially even extend down to $2,700. It's a really high-stakes juncture.
But there is a potential silver lining, right? Or at least a bullish pattern that some analysts are watching for.
Yes, the hopeful scenario revolves around a potential double-bottom structure forming right around this $3,100 to $3,200 level.
And we've seen this before.
We have. This pattern mirrors a structure we saw just before the massive ETH rallies back in 2020. If this technical structure validates, it could signal that a strong long-term reversal is coming. So right now, this range is the battleground between capitulating LTHs and accumulating smart money. It's the single most important technical zone to watch for Ethereum.
Okay, let's transition to the macroeconomic and corporate news that has really set the stage for this sudden market move. Our insights are, of course, based on aggregated data compiled and analyzed by CryptoCore from various media reports.
And we have to start with the macro headwinds. This synchronized sell-off Bitcoin down, S&P 500 down 1.8%. It's directly attributable to an abrupt shift in Fed rate expectations.
The Fed signaling they're going to stay tighter for longer.
Exactly. Fed officials are signaling a willingness to keep monetary policy tight for longer than the market had previously priced in. This hawkish shift drove up real yields in the bond market, and that severely pressures the present value of long-duration assets.
Which includes high-growth tech stocks and, of course, Bitcoin.
Of course. NVIDIA, Tesla, Bitcoin, they all got hit hard.
And adding to this uncertainty, the U.S. government shutdown has delayed the release of the October CPI report.
The uncertainty that this data vacuum creates is just immense. If the Bureau of Labor Statistics can't reconstruct the data, we might be facing a 2-month gap in critical inflation information.
which forces traders to fly blind, in a sense.
It does. It forces them to rely less on short-term economic metrics and more on structural factors like institutional fund flows and liquidity, which, as we know, have been overwhelmingly negative. This data void is just increasing market uncertainty and encouraging a risk-off posture across the board.
The most immediate and painful trigger, though, was that institutional liquidity crisis. The ETF outflow was just a record-breaking cascade.
It was pure institutional capitulation. That $868 billion BTC ETF outflow was the direct trigger. It catalyzed over $1.1 billion in total crypto liquidations across the derivatives markets in just 24 hours.
And those are mostly leveraged longs getting wiped out.
Overwhelmingly.
Yeah.
And that forced liquidation just accelerated Bitcoin's drop below 97,000 and created this downward spiral of price action.
Now, on the corporate strategy front, the market is intensely focused on strategy's response. Michael Saylor says they are accelerating BTC purchases and explicitly denied any large sale rumors.
Right, he's trying to calm the market by saying the transfers were just a $5.7 billion custody reshuffle.
But the market's reaction to their stock, MSTR, reveals a pretty profound divergence in sentiment.
A profound divergence is a good way to put it. MSTR now trades at that rare negative premium, with its market cap below the net value of its Bitcoin holdings. This suggests investors are now deeply concerned about the corporate layer.
Worried about dilution, leverage.
Exactly. Dilution, aggressive leverage, corporate governance. They're prioritizing direct ownership of BTC over this intermediary structure. It's a major vote of no confidence in the corporate wrapper model, despite Saylor's strong conviction.
And this skepticism seems to align with another corporate shift we saw from a major mining company.
Yes, Bitfarms. They announced plans to phase out Bitcoin mining over the next 2 years. They're pivoting toward high-compute data centers, focusing on artificial intelligence.
Citing better returns from AI.
Explicitly. They stated that the projected net operating income from AI infrastructure is higher than that of mining Bitcoin. And this move highlights a crucial strategic pressure point for the whole industry.
Which is?
If the BTC price is stuck near this $94,000 production cost, and AI offers a structurally better return on specialized hardware, we could see more miners shift their focus. And that would impact the network's long-term security and structure.
Okay, let's pull back and look at the regulatory and global outlook. Macro analyst Raoul is actually highly optimistic about what he calls a liquidity flood after the U.S. government shutdown is resolved.
Powell's theory is really interesting, and it hinges on two powerful mechanisms. First, the resolution of the shutdown would likely lead to a drawdown in the Treasury General account, the TGA.
Injecting cash back into the system.
Right back into bank reserves and the short-term money market. Second, and this is a big one, the confirmed end of quantitative tightening, or QT, on December 1st of this year. That means the Fed stops actively sucking liquidity out of the market.
And you combine that with stimulus from China and Europe.
And Powell sees this as a liquidity bazooka that could rapidly overwhelm the current macro anxiety and serve as a massive tailwind for risk assets like crypto.
Regulatory clarity in the U.S. is also a major focus if the shutdown ends.
Powell is optimistic that the Clarity Act could finally be finalized post-shutdown. That would provide the kind of regulatory structure that institutions have been desperate for before they can commit capital long-term.
It's the prerequisite for the big money to come back.
It is. And on top of that, a new survey shows that Bitcoin is appealing right across the U.S. political spectrum. Democrats seem to like it for financial inclusion, while Republicans and independents appreciate mining's potential for grid stability and the freedom of decentralized transactions.
So a growing, stable, cross-party political foundation.
That's the idea.
Meanwhile, across the pond, the UK central bank is treating stablecoins with extreme caution.
The Bank of England proposed what the industry is calling a disproportionately cautious stablecoin regulation. They've suggested limiting personal holdings of systemic retail stablecoins to £20,000 and corporate holdings to £10 million.
That's pretty restrictive. What's the fear there?
It reflects a global banking fear. Central banks are deeply concerned that large, successful stablecoins could displace traditional bank deposits, which would threaten the entire fractional reserve system. This cautious, almost prohibitive regulatory approach in major jurisdictions is a key long-term variable that could constrain stablecoin-led growth.
Okay, that's a lot to digest on the news front. Let's move to a quick technical summary. What are the charts telling us about the short-term momentum for Bitcoin and Ethereum?
In a word, The technical indicators for both assets are screaming strong bearish momentum.
Okay, let's break that down for Bitcoin.
For Bitcoin, the relative strength index, the RSI 14, is either deep in oversold territory or getting there very fast, so below 30. Now, while this suggests selling pressure is reaching exhaustion and a short-term relief bounce is technically due.
The underlying trend is still fiercely negative.
Fiercely. And the momentum indicators confirm that aggressive bearish movement.
Looking at the MASTD.
The MASTD is significantly below the zero line, and its negative histogram is expanding rapidly. This confirms the acceleration of the bearish trend. The moving averages are in a clear reverse order, and the price is now testing that multi-month support at 94,000. It's signaling a potential death cross setup if things don't turn around quickly.
And Ethereum's technical picture, as we discussed, seems even more precarious because of that critical monthly support test.
It is. Ethereum is showing a more severe bearish setup. The entire focus right now is fixed on that crucial weekly 50 EMA support band, spanning from $3,100 to $3,200.
It's the last line of defense.
It really is, before a potential major structural breakdown. If this critical support fails, the technical model suggests a high risk of a rapid drop toward the $2,800 region.
But as you said, there's that smart money accumulation hinting at a possible double bottom.
Exactly. It's mirroring that 2020 pre-rally structure. So the validation or invalidation of this specific pattern is the most important technical call for ETH right now.
Okay, so considering all of that, the market structure, the news flow, what are the most essential trading watch points that everyone should be focused on right now?
I think we can boil it down to 5. Number 1, the absolute top priority is watching the $94,000 Bitcoin support level.
JPMorgan's production cost.
Exactly, the crucial pain threshold. Holding this level is just non-negotiable for immediate market stability. If 94,000 breaks decisively, you have to be prepared for a rapid slide, potentially targeting $88,000, because there isn't much meaningful support below it.
Okay, number 2. We need to see conviction from the institutions. The catalyst for the crash has to be the catalyst for the recovery.
That's exactly right. So traders most monitor the spot ETF net flow data. For any kind of sustainable recovery, those record outflows have to slow down substantially or, ideally, reverse into net inflows.
Without institutional buy-in, any rally is just a trap.
It's likely to be weak, short-lived, and a very poor risk-reward trade.
For Ethereum, the primary risk is that internal selling pressure from the long-term investors.
So the third watch point is tracking the ETH long-term holder selling pressure. We need to see that daily average of 45,000 ETH being sold start to subside.
So keep an eye on on-chain data for that.
Yes. Monitoring for reduced exchange deposits and slowed movement out of old wallets is necessary before Ethereum can find a true structural floor. Until that cohort pauses, the overhead supply is just too great.
Okay, moving to number 4. The macro picture provides the highest potential for an external catalyst to flip this market.
Absolutely. Our fourth point is monitoring the macro liquidity catalysts. The market is waiting for the finalization of the Clarity Act and, more importantly, that impending QT termination on December 1st.
And the potential TGA fund release.
Correct. If Raoul Pal's liquidity flood materializes, it could override the current bearish pressure and offer a powerful tailwind. Traders need to have alerts set for any related news.
And lastly, what about the health of the derivatives market after this huge flush out?
The fifth watch point is looking for healthy stabilization in the derivatives market. We need to see open interest recover steadily without a corresponding massive drop in price. And that needs to be paired with a move toward a sustained, slightly positive funding rate.
What does that signal?
It signals renewed, healthy long positioning. If the price just spikes sharply without the open interest recovering, it suggests a dangerous, temporary short covering rally, not a true market reversal.
Oh, okay. Let's synthesize all of this data into our multi-tiered market outlook. Short-term, mid-term, and long-term. What should we anticipate in the immediate future, say the next few days to a week?
The short-term outlook is, I think, high volatility with a strong bearish bias.
So more the same, basically.
Expect continued, severe turbulence and likely multiple tests of that critical $94,000 support level. We'll probably see some temporary technical bounces because of the extreme oversold conditions on the RSI.
But they won't last?
Unlikely. Sustained rallies are highly improbable unless those institutional ETF outflows stop immediately. And if 94,000 fails, the immediate risk of a panic move down to 88,000 remains extremely high.
Okay, so looking a bit further out, weeks to months, is there a chance this crisis turns into a structural opportunity?
I think the midterm outlook centers on a significant inflection point potential. This period aligns perfectly with the expected materialization of those macro liquidity tailwinds we talked about.
Raoul Pal's liquidity flood.
Exactly. If that scenario plays out, specifically the end of QT and the TGA fund release, it could decisively override the current macro bearishness that's being driven by Fed uncertainty.
And that kind of liquidity, combined with regulatory clarity.
It could trigger a swift institutional return. In hindsight, this current price adjustment could be viewed as a necessary preparation stage before the next structural rally. And you still have strategies persistent buying, acting as a sort of midterm floor against a total collapse.
Okay, and finally, the long-term perspective, 6 to 12 months and beyond. Does the fundamental structural bull thesis survive a massive correction like this?
I believe the long-term outlook remains structurally bullish. The fundamentals of scarcity and institutional adoption, they haven't gone away.
JPMorgan is still holding to its price target.
They are. They maintain a $170,000 price target for Bitcoin based on volatility comparisons with gold, emphasizing its growing role as a store of value. And that cross-political appeal of Bitcoin in the U.S. provides a stable foundation for sustained institutional and political support, no matter who is in power.
So what's the primary variable or risk that could derail this otherwise positive long-term outlook?
The key variable is, and always will be, global liquidity. If, contrary to expectations, the Fed or other major central banks were to implement some unexpected, powerful policy reversal that severely constricts liquidity.
Or if we see really restrictive regulation adopted globally.
Exactly. If the UK's cautious stablecoin limits became the global standard, for example, the long-term thesis would face significant challenges. So it really hinges on when, not if, Bitcoin's macro tailwinds and Ethereum's ecosystem growth manage to align powerfully once again.
Okay, let's do a quick recap of today's analysis. The market has entered a deep correction driven by a combination of macroeconomic pressure and record institutional flight. The total market cap dropped sharply to $3.21 trillion, and investor sentiment is firmly near extreme fear at 22.
The crucial driver here was that institutional pressure, highlighted by a massive $1.13 trillion total ETF outflow. Bitcoin is now fighting desperately to hold that critical $94,000 production cost support. And Ethereum faces heavy supply from its long-term holders, but it's showing that counter-signal of strong accumulation by smart money whales in this price range.
And our midterm hope is really anchored in those potential U.S. macro liquidity shifts, specifically the termination of QT and the release of TGA funds. Those could serve as a powerful catalyst to reverse the current downtrend, transforming this correction into a powerful inflection point for the market.
We hope the data we share today helps you understand the current volatility and, helps you navigate your investment decisions wisely.
That concludes the news we prepared for today. CryptoCore, your cryptocurrency navigator, analyzes the latest trends daily to deliver fast and accurate information to you. Don't miss our next deep dive. Ensure you subscribe, like, and turn on notifications.
Please refer to the respective media sites for detailed information. We are now disclosing the sources for the articles cited today. Unchained, CryptoSlate, Crypto Briefing, News BTC, Protos, Crypto Briefing, Crypto Potato, Crypto.news, CryptoSlate, Cointelegraph, and News BTC.